All right, today we are digging into one of the biggest financial stories of the year, the absolutely incredible, record-shattering surge in the price of gold. And believe me, when I say record-shattering, I really mean it.
Look at this number. This is what has everyone talking. Gold futures, which are basically just contracts to buy gold down the road, recently blew right past the $4,000 barrier for the very first time. They hit an all-time high of $4,072 an ounce. Just a stunning, stunning milestone.
So, okay, that's the what. But the real question, the one we're here to answer, is the why. What on earth is fueling this massive gold rush all of a sudden? That's exactly what we're about to break down. So first up, let's just take a second to put this new record in perspective. How big of a deal is this really in the grand scheme of things? Well, the scale of gold's performance this year is just staggering. It's up about 54%. And to put that into context for you, that's better than most stocks in the S&P 500. It's truly one of the year's absolute best performing financial assets, period. So what is lighting this fire? Let's dive into the core forces that are really pushing gold to these brand new heights. It's not just one thing. It's more like a perfect storm. Of course, you've got global uncertainty, which is always a classic driver for gold. Then there's this massive investor FOMO, fear of missing out, with tons of money pouring into things like gold ETFs. We're also seeing this really fascinating thing called the debasement trade, huge purchases by central banks around the world. And, maybe most importantly, the critical influence of a weaker US dollar. And if you want a perfect example of that fear of missing out effect, here it is. That's how much money flooded into those gold ETFs last month alone, a record-setting $17.3 billion. Investors are seeing prices climb, and they're jumping in because they do not want to miss this rally. Now, let's talk about that bit of jargon, the debasement trade. So what is it? Well, in really simple terms, it's a strategy investors use when they start to lose confidence in the traditional pillars of the financial system. Things like the value of the dollar or the stability of government debt. They basically buy gold as a form of insurance. Yeah, and this line from our source material just sums it up perfectly. It's all about hedging against a loss of faith in the very things that are supposed to be the safest bets in global finance. And that, right there, is a really powerful psychological driver for demand. Okay, let's zoom in on what might be the single most critical factor in all of this: gold's deep and kind of inverse relationship with the US dollar. Seriously, if you can get your head around this, you can understand the entire gold market. So here's how it works. When the value of the US dollar drops, two things happen that are fantastic for gold. First, investors start looking around for something more stable to hold their wealth in, and they often flock to gold. And second, because gold is priced in dollars globally, a weaker dollar actually makes it cheaper for buyers who are using other currencies. It's this kind of double whammy effect that really juices the demand. So, we've covered the why, now let's shift gears and look ahead. Where do the experts think gold is going from here? And what are the potential risks to this huge rally? Now let me tell you, some of the big players are feeling very bullish. Take Goldman Sachs, for example. They've seriously raised their forecast. They're now predicting gold could hit $4,900 an ounce by the end of 2026. Why? Because they think the factors driving this rally, especially central bank buying, are sticky, meaning they're not going away anytime soon. Okay, but even with these bullish forecasts, there's always a what if, right? A common assumption is that if the stock market crashes, everybody just runs straight to gold. But is it really that simple? Let's take a look at what the data actually says. Well, according to the World Gold Council, who analyzed almost 50 years of data, it turns out it's not the stock sell-off itself that really dictates what gold does. No, the single most important factor is what happens to the US dollar during that sell-off. See, it all comes back to the dollar. And here's the good news for gold investors. History seems to be on their side. In 2/3 of all stock market corrections going all the way back to 1973, the US dollar has actually fallen. So this historical trend suggests that even in a market crash, the odds favor a scenario that's typically very good for gold. Of course, no asset just goes up in a straight line forever, so if gold does pull back, analysts are watching a couple of key technical levels. The first real test of support would be a drop to around 37.15, which is its 20-day moving average, just a simple measure of its recent price trend. If it breaks through that, the next major floor could be around 35.15. Think of these as the key signposts for the health of this rally. So, after all of this, we're left with one last really crucial question. Is gold's record-breaking climb the beginning of a new era for the metal itself, or is it just the most obvious symptom of a world that is slowly losing faith in its default currency? Now that is the real story to watch.